Okay. Hello for the third time. For those of you who've been waiting, and for those of you who just joined, Justin Kribs with InsMed. I am going to be giving the lecture today on income and taxes that is brought to you by Financial Beginnings. Also on this webinar is going to be Joanne with Financial Beginnings, and she is the program manager for the state of California. I'm located in Washington State, and I am broadcasting live from our youngest daughter's bedroom. So little caveat here, a head might peek in the door because for whatever reason, whatever dad is doing is the most interesting thing in the world at the time. And if it does happen, I'll pause for a moment and then get going again. So anyhow, today's lecture is going to be the basics. This is not, again, a lecture on, 50 ways to save on taxes. No, this is really kind of like establishing, okay, what is the tax system? How does the tax system work? What are things you really need to think about? How does it apply to me and my situation? What are different things I should be thinking about in terms of tax? So again, when you, with my background working in academia, I was at Oregon Health and Science University, where I was hired as a financial planner for students and alumni on staff. So my my exposure to what people were dealing with as they were going through their their didactic years or clinical years, transitioning into their residency, then transitioning from residency into roles as an attending, is of course you would see multiple scenarios always pop up. And one subject that was never taught, of course, because it's not on your steps, it's not on your shelf exams, is tax. I mean, no one, you don't have an instructor sitting down with you talking about tax. Usually your first exposure to tax happens when you're in your residency program and you're talking to your fellow residents, or you're talking to your attending, or you're talking to other professional on campus, or you hear a lecture like this and they say, okay, this is tax. And you sit there, okay, what is that? I know I have to pay taxes, but what does it all mean to me? And what's different, what changes? So again, this is going to be very basic. Yeah, you can get super complex with things depending on your role, where you're working, etc. But we won't get into that today. You can ask some questions, maybe I'll answer them. My background is as a certified financial planner, but I'm not a CPA. So I have tax exposure, but I wouldn't consider myself a tax expert. So taxes, here's our agenda. The tax structure, deductions, FICA, what are capital gains, marginal and effective tax rates, how you break down a paycheck, W-2 versus 1099. How is it that you are compensated? And then, of course, we'll get in a few deductions and credits. And we'll also think long-term, what is tax diversification? What does that mean? And how does it apply to you? And why is it important now? And some of these things, like tax diversification, for example, it's not something you really think about when you're first starting work. It's something that applies to you as you go into retirement. However, how you start setting yourself up now will affect you 20, 30 years down the road. And now that date that we have in front of you right there, that Wednesday, July 15th, that is tax day after the CARES Act. So that's the day that you have, that's how long you have to file your taxes for 2019. Well, probably back to April in 2020, 2021, but that's our new tax day, Wednesday, July 15th. So this is an old saying, it gets thrown around a lot. Two things that we can be sure of: death and taxes. And when you think about taxes, taxes are part of everything. In the state of Oregon, you have income tax, but there's no sales tax. I live in the state of Washington. We have a sales tax, but we have no income tax. Then you have California, which has the best of both worlds, income tax and state tax. But you can also look at taxes from a city tax, municipality taxes. My clients are in the state of New York. If they're in Manhattan, there's an income tax. You have your state income tax, you have your city income tax, you have your federal income tax. And when you think in terms of taxation and how much, of course, your take-home pay is, and this is something I'll do with my students and even with my the residents that I would cancel, it would be, okay, well, this is what your salary might be, but what exactly is it you're living on after tax? What's this tax structure of where you are heading to? So even as you look at your situation now, You know you're paying taxes, but how many different types of taxes are you paying? And how much of your income are you actually keeping? And then also we have down here on the assets, I added a little marker here about equities, stocks. So assets that, you have a capital gains tax on, capital gains rate. Capital gains is when you buy something and you buy something, you sell it for a higher price than what you bought it for later. So there's always a tax. Now, of course, the one we see the most is your income tax. And in the US, we have what is known as a progressive tax structure. As you earn more money, you pay taxes. So it goes up. Now, these are the rates for 18. I've updated these rates for 2020. And so, oh, sorry, now on that slide, this is your deduction. So when you have your tax structure, you're looking at it saying, okay, well, how much do I get taxed and on what amount do I get taxed? And you have people say, well, I'm at, the 27% or the 32% tax rate or 24% tax rate. People talk about, your effective tax rate, your marginal tax rate, your average tax. You hear everyone talk about what is their tax rate. Thing that we have to think about and we have to keep in mind is that all of us start every year at the tax rate of 0. If you're not earning any income, your tax is 0. That's what it is. Now, this really trips up again with when I have a medical student transition to residency, they'll look at me and say, well, I didn't pay any taxes last year, therefore I'm exempt from taxes the next year. Because they'll fill out their W-4, which is their tax withholding schedule, and they'll say they're exempt from taxes. At least that's what we're doing before I started. And you have to educate people. So what you're looking at, you're saying, okay, what is a tax that you pay on the next dollar earned? So now you're talking about your marginal tax rate. And in this case, as you look at it for like an individual, you say, all right, well, if I earn from 0 to $9,524, it's at 10%. As you earn over that 9,524, now goes to 12%. So it's 12% between that 9,000 number and this 38,000 number. Now you're at 12%. As soon as you get over that 38,000 number, now you're at 22%. And so on and so forth until you max out at 37% marginal tax rate. And marginal tax rate is the taxes paid on the next dollar earned. So this individual right here, for example, they're not charged 37% on every dollar they've ever earned. No, just on those dollars after that certain amount. So as you are a resident transitioning to an attending, you look at it in terms of, okay, well, how will my tax bracket change? How will my tax situation change? If you look at people who have taken furloughs during the COVID-19, if they were in elective surgery positions and they had to see their hours reduced, they might actually see their marginal tax rate reduce. I have a friend of mine who is a anesthesiologist, and he has spent many painful hours trying to figure out exactly how many hours does he have to earn, or how many hours does he have to work to earn the same amount of money but at a lower tax rate. He's trying to find that math of, okay, how can I balance earnings and income to where I can get my income tax to go down, but yet still net the same amount coming home. And he's still trying to find that math. And I'm telling him, let me know when you find it. Because a lot of people want to know that as well. Because with our tax structure, you earn more money, you pay more money. You earn less money, you pay less money. It's a progressive tax structure. Now you can do things to reduce your taxable income, which we'll get into later. However, what you can do to reduce it is limited. So your deductions. Now I'll talk to people about deductions, and this is where people start kind of getting confused about, okay, what about my adjusted gross income? What about, again, going back to that marginal effective tax bracket. So your deductions are what you reduce your taxable income. This reduces your taxable income. So an individual has a standard deduction for 2020 of $12,400. Right? So if I earned, $20,000, then my standard deduction will reduce my taxable income by 12,400. Therefore, my taxable income is what? That'll be 7,600. Well, now I'm at a 0% tax bracket, or I should say 10% tax bracket. So my tax bracket has gone down because of that deduction. So as an individual, you always say, okay, here's my standard deduction. As your income increases, that standard deduction becomes less and less helpful, of course, because that standard deduction doesn't grow with you. That's when people look at, okay, what about itemized deductions? So you have your standard deductions, which are finite, they're limited, they don't grow. If you get married, they double up. Head of household, they go get a little bit bigger. Married filing separately, they reduce back down to single. But standard, it's finite, it's limited. Then you talk about itemized deductions. So your itemized deductions are deductions that are based off of what the IRS says you can deduct from your taxes and what the limits there are. And with the last tax bill that was passed, they really put a cap on itemized deductions to where they don't help out as many people as they used to. You know, being able to deduct state income tax, paid mortgage interest, caps on medical expenses, or the, how much in medical expenses you actually have to have before it becomes reasonable to deduct. And so when you hear people talk about, okay, do you use a standard deduction, or do you use an itemized deduction? This is what they're asking you. So if you're talking to a tax professional, they're asking you, okay, have you been using the standard deduction, or have you been itemizing? And if you've been itemizing your deductions, that's where you get kind of put under the radar. And then we hear people talk about, I was audited. This is usually what they're auditing. What is it that you were doing that reduced your taxes so much? And I've heard people say, well, according to my tax professional, they rarely ever audit. Therefore, we're taking as many deductions as we can. Well, you always can lose a lot if you do things wrong. And you have to think about the penalties for misfiling are much greater than usually the tax you would have paid. So I know people really like to get aggressive with itemized deductions. Of course, as your income goes up, you want to try and reduce your tax exposure. It's only natural. However, you always have to keep in mind that as you're looking at your itemized deductions, there are limits to those, and there are reasonable ways of looking at a deduction or creating a deduction. Is buying the home the best way of creating a deduction for you? And does the tax benefit of that home purchase outweigh the other financial costs of the home? And being that everything is affected by tax, you never look at one decision as its own standalone item. You always look at a decision as it affects the whole. Now, your standard or itemized deductions reduces the amount of taxes, or I should say, the amount of income that is taxed. So, but this does not lead to things like, your adjusted gross income, which has a direct impact on loan repayment. So if you're on a federal income-driven loan repayment program, they're looking at your adjusted gross income, which is figured out before your deductions. So different layers to everything. Now, of course, this is when you're looking at things such as your state and federal income tax, your deductions, itemized deductions. Then, of course, all professionals, you have to deal with FICA tax or your Social Security tax. And this is something that every professional will deal with. Now, Medicare tax is 1.45% of every dollar earned. There's no cap to that. So you have your Medicare tax, which is always 1.45%. And I've had people come to me and say, okay, what is FICA tax and why does it keep, how can I get rid of it? Well, you can't. Social Security tax is 6.2% of every dollar earned up to $137,700. So after you've earned $137,700, after you've earned that much, any dollar over that is not taxed at 6.2%, but it will still be taxed at 1.45%. So you can actually, there's a limit to the income tax for FICA purposes for Social Security, but not for Medicare. So you can reduce your FICA tax by using a flex savings account. So if you have a flex savings account at your employer, you can actually contribute to an FSA, and an FSA contribution will actually limit or reduce your Medicare and FICA tax base. That's the only thing I can think of that will do that, at least a relevant thing that you can do. Now, there are some people out there who will say, well, I don't pay Social Security tax. Or you might find an employer that will say, hey, we don't charge Social Security tax. We don't do that. You'll see in their benefits, as one of the benefits they'll offer you, they'll say, okay, in lieu of reducing your paycheck for Social Security, we'll instead put that money into a retirement account for you. State of Massachusetts is one example. The residents I would work with at UMass, instead of putting money into Social Security, they'll instead put 6.2% of their paycheck, automatically your employer does this, into the state pension fund. So it's essentially privatized Social Security. Now their time at UMass does not count towards earning the 40 credits you need to earn to become eligible for Social Security benefits. So with Social Security, you get 4 credits a year that you worked full year while paying FICA. If you're not earning or paying FICA, you're not earning those credits for Social Security benefits. That's of course if you have the people say, okay, well, I would rather go work at an employer that puts that money into a retirement account that I can take with me whenever I want, because that's what they're able to do at UMass. They put the money into the state fund, 6.2%, and they can take that money with them when they separate from service. Versus for those of us who would pay into Social Security, that money we can't touch at all until we retire, until we reach retirement age and the government says, okay, you are 70 or 63 or 67 or whatever the age is that they calculate at the time of our retirement, then they let us have it. So as you're looking at tax structures, as you're looking at your own paycheck, as you're looking at future paychecks, as you're looking at different options, you look at how tax affects you. There's the FICA tax, and how is that going to affect your paycheck? How is that going to affect future retirement? And then there's also going to be, okay, what is it that I can bank on in terms of my take-home pay? Now, there are other taxes such as capital gains tax. Now, capital gains tax is a tax that you pay when you sell an asset. So capital gains is where you hear people talk about, okay, tax-deferred savings. You put money into your retirement account, your 401k, as an example. It grows tax deferred, and then you take it out taxable. So when they're talking about that tax deferred benefit, what they're really talking about is capital gains tax. Because if you have a retirement account and you bought a stock in that retirement account or an investment in that retirement account at, let's call it $10 a share, and then you sold it for $20 a share, well, you don't have to worry about capital gains tax within a retirement account. It grows tax deferred. Capital gains tax affects you if you are not investing in a retirement account. Capital gains tax affects you, of course, with real estate. When you buy something of value and you sell it for something of greater value. Now, your capital gains rate will be determined, of course, by your marginal tax rate. Also, it's determined by what is known as your cost basis. So the cost basis is the cost that, or the amount of money you spent to purchase whatever it is you just sold. That is your basis. And basis is a very important thing to always keep in mind. When people are investing, when people say, hey, let's say that you have a portfolio of funds. Let's say you worked, you created your own individual retirement account, or you have your own, I should say, your own individual account. You open it up with Robinhood or whatever it is, and you bought an investment in it. You go talk to a financial professional who says, hey, let me manage that investment for you. You say, okay, and then they tell you to sell everything that you own. Well, you always have to understand what your basis is, because your basis determines how much tax you will pay when you sell all of your various assets. So that's your capital gains tax. So again, that isn't income tax. It isn't FICA tax. Capital gains tax is its own tax. It won't show up on a paycheck. It shows up when you actually get your reports from your mutual fund or from your brokerage companies. When you get your 1098s and 1099s and everything else, that's your tax reporting documents. That's where it's coming from. So our federal tax structure, like I said, it's a progressive tax structure. So if people say that, hey, I'm in the 37% tax bracket, they're not paying 37% on every dollar earned. They're paying it on every next dollar over a certain amount. And so you have to start thinking about things in terms of what they say are marginal taxes and average tax. So marginal tax. As I said earlier, we start with a marginal tax rate of 0. If you're not working, you're not earning an income, you have a tax rate, you have a marginal tax rate of 0. They don't just arbitrarily say we're going to tax you X amount of dollars for the year. It's all based, of course, on income. As you start earning your income, your tax rate goes up. So here we'll have it like in this case, you have a person who's at 32%. They'll pay 32% on every dollar earned between 163, 301 and 207, 350. So all of these dollars are taxed at 32%. Then they cross the next threshold and they're taxed at 35%. Then they cross this threshold, and this threshold is pretty big. The 35% threshold is large. I don't typically deal with a lot of people who go out of that threshold. All of a sudden now it's at 37%. So, and that's where it will stay, 37. Now that's marginal. Effective. Your effective tax rate is what you paid in taxes divided by your taxable income. So if you paid $2,000 in taxes and you had taxable income of $10,000, your effective tax rate is 20%. Your effective tax rate will always be less than your marginal tax rate in a progressive tax system. So effective will always be less than marginal in in a progressive tax system. As you're looking at your pay stubs, as you're looking at your compensation structure, as you're looking at, okay, how is it that your income bumps up? Let's say you have a contract based on RVUs or WRVUs or however it is what they want to compensate you. And they say, okay, we will pay you as you generate this much more income, we'll give you X percentage of that, which will then lead into your pay stub. Well, you can take a look at your income tax and say, okay, well, sit down with your tax advisor and start calculating out, well, if I make this much more money, how much of it do I actually get to keep? And is it worth the additional time spent to earn it? Again, my buddy who's an anesthesiologist who is always looking at that. He's trying to find that magic calculation. And really, as you're looking at comp structures, is always about, okay, well, is the work put in worth the revenue received? And as you're trying to figure out, okay, how will it affect me tax-wise? That's what you're looking at. You're looking at, okay, how are these additional dollars earned added to my paycheck? How much of that do I actually get to keep? Also, as you're looking at things such as pre-tax savings or other items you can do or other structures or strategies, I should say, that you can utilize to reduce your tax rate, how much will those benefit you? So taxes paid. Now, of course, as a lot of you have had experience with already, as you transition into a residency, as you transition into any new job, you have to do your W-4. Your W-4 is what determines your withholding. You can increase your withholding or decrease your withholding with your W-4. This is when people always ask me, okay, how many exemptions should I take? How many people should I claim? Which extra should I apply for? what is it, how many people or how much tax should I have withheld? And of course, it's always going to be determined by the individual and their situation itself. You have a single income household of 5 people. Well, that person needs to withhold less tax than a dual income household of 2 people. More deductions, less income, etc. So as you look at that W-4, and your W-4 you can update whenever. If you're doing your taxes, if you always tell people to always get an estimate for the next year. If you owed for the prior year, you just adjust your W-4 to increase your withholding for the next year. And one thing that really trips up people, especially as they go from, again, medical school to resident to attending, as you have big income jumps, is they don't update their W-4 as they transition. And I've had countless conversations with people that have come back to me at tax time and say, oh my gosh, Justin, I owe $15,000 on my taxes. What happened? Well, did you change your withholding when you changed your job? So I had one individual, she stayed on at the same institution she did her residency at. She transitioned to a role as an attendant, as a hospitalist, and she never updated her W-4 to account for her increase in income. And it's one of those, of course, for those of us who have had experience with income tax, we go, of course you update things. But if you've never had that experience, you've never had that change, it's not something you're automatically thinking. You're thinking, hey, I already did my onboarding. I don't need to do this again. They already have my W-4. Nothing's changed. Well, yeah, something has changed with your income. Also, as you're looking at people who give you bonus structures, again, your income and how that compensation is structured, you change your W-4. And the same thing when I've had my clients that have had to take furloughs or have had reduced hours because of COVID-19, going back to them and saying, hey, you might want to adjust your W-4 because you're going to have less income this year. Therefore, it doesn't make sense to withhold at the same rate. What changed here will affect something down the line in the later months and years. So kind of going to a very basic breakdown of a paycheck. You have your salary, base salary, resident salary. This is what their base, if they were not doing any sort of pre-tax withholdings, that would be their tax base. But in this case, this person, they're withholding pre-tax into their retirement account. Because they're withholding pre-tax, this reduces their tax base for federal and state tax. The 403B contribution does not reduce their tax base for FICA tax. Okay, so this is reducing their tax base. Their tax base is then utilized to determine how much they would have withholding for state tax, federal tax, and if they have city or county tax, those as well. After that has been done, then the paycheck is reduced for your after-tax deductions. In this case, there's supplemental life insurance, they have accidental death and dismemberment, short-term disability, like different after-tax deductions. Now, a pre-tax deduction reduces your paycheck proportionally based on your tax bracket. So $250 a paycheck does not cost this person $250 flat. No, it only costs them a portion of that based on their tax bracket. An after-tax deduction will reduce their paycheck dollar for dollar. So if they did not put anything into their pre-tax 403B, their tax base would not have gone down. Therefore, they would have been charged more in state and federal taxes. If they made this an after-tax deduction, then again, their tax base did not go down and they would have had $250 taken out dollar for dollar from their final paycheck. So when people, again, talk about IRAs versus Roth IRAs, or pre-tax retirement accounts versus a post-tax retirement account, which is better? Going back to, what is your tax situation? If you only have one type of retirement account available to you, most private practices that I encounter have one retirement account available to them, which is your typical 401k account. All right, $19,000 pre-tax goes into the 401k. Now they have no other accounts available for retirement savings or for tax strategies. Most institutional employers that are academic institutions have more than one type of account because there are more different types of accounts that are available to them. Let me double check. Yeah, I believe it was 19,000 for this year's contribution limits. So as you're looking at your employer, as you're looking at future employers, as you're comparing benefits, as you're comparing your different scenarios within your household, and as you're considering tax, okay, what are the strategies we have available to us based on the employer that we utilize or the employer that we're working for? Now, of course, going back to the idea of, over withholding, under withholding, this argument comes up all the time, of course. Don't, under withhold. Don't give the government too much money because it's an interest-free loan that you do not recuperate until you file your taxes. Versus don't pay later, you might not be able to afford it. Going back to COVID-19, the CARES Act, and the extension of the tax filing deadline to July of 2020 for 2019 taxes. So for those who over withheld, they will file their taxes right away to get their refund as soon as they possibly can. For people who lost their job but under withheld, they might not have the financial ability to pay their taxes when they would have been due in April. So instead, they have until July to come up with the money to pay their taxes. Myself being a conservative individual, I believe in getting a refund a lot more than I care about if I gave the government a tax-free loan, or interest-free loan, I should say. Because I would rather know that I don't have to pay an extra fee or an extra, account due the next year as I'm planning for that calendar year. Nor do I look at a tax refund and say, oh, well, I'm counting on getting this money later on. It's like that money is, to me, it's never part of a budget. It's never part of the calculation. As long as I know, or I'm comfortable that I will not owe, I just carry forward the same strategy for next year. Now, of course, there are people who will counter that argument and say, well, why not reduce your taxes? Why not reduce your withholding? Take that additional income that you didn't withhold from your pay stubs or your paycheck and invest it and grow with your investments. Of course, that's a more aggressive strategy with the assumption that things will always go up. So as you're looking at your situation, you think to yourself, okay, what is it I'm more comfortable with? Paying more now versus paying something later. It all comes down to your preference. There is no better way. I've had people get refunds of, $19,000, $20,000. Yeah, that's being really aggressive with your withholding. But again, I've had people owe the exact same amount because they under withheld the previous year. Now, getting back to the idea of planning and cash flow and how you are managing your day-to-day lives, if you need to reduce your tax withholding in order to make the cash flows work, that's when you have to take a look, of course, at more items of what's going on than just that one cash flow. There's other things that are going on there. Just like the clients that I had that owed $15,000 the previous year, where is that money going? Well, of course, in their case, it was a lifestyle choice. They bought a camper and a truck, and it was just one of those, they needed the extra money to make their payments on what they purchased. And I don't ever look at a person and say, okay, well, you know, that was a really bad idea. No, they made that decision. That was the decision that they made. They were adults. How do we adjust going forward? It doesn't help somebody to, you know, dig out of a situation by hammering that point home. They already feel it. So how do you move forward? So when you get your W-2, of course, you'll start seeing this. You have your, in this case here, your Social Security wages. Here is your wages and tips and other compensation. So they'll say, okay, this right here was what they taxed for Social Security. This is how much was, oh gosh, this is what was paid out. So there's a difference there. So this base did not change. This is what they paid in salary. This is what they paid taxes on because they put money in pre-tax to a retirement account, or they had other pre-tax contributions that they were doing, such as medical insurance. So one thing that comes up a lot, especially as you're transitioning through residency, is you look at people who say, okay, I'm W-2 versus 1099. So W-2, you will find people say, okay, I'm going to go work for a group. And as with that group, I'll be an independent contractor through that group. Usually happens with anesthesia or emergency medicine, two examples, sometimes primary care. So you are contracting through that group as a 1099 employer, a 1099 practitioner. So W-2, you are an employee. You're qualified for public service loan forgiveness. They pay half the FICA tax. You fill out again your W-4. They are party to that. Like, you are employee-employer relationship. And because of that, of course, W-2 employees, you're limited to whatever they have for their benefits, for their retirement, their health insurance, etc. When you're a 1099, you are an independent contractor, and depending on how you set up your business structure, S Corp, LLC, and how you bill through your business determines, of course, your income and your tax status. Now, for purposes such as public service loan forgiveness, 1099 employees or 1099 contractors are not eligible for public service loan forgiveness. However, some of the benefits are you can set up your own retirement accounts. I have an individual who I work with. They could have worked for the state as W-2 or 1099. They chose 1099 because they did not like the benefits that are available to them. And so they bill out as a 1099 independent contractor through the state. So as you're looking at your structure, you might be brought up to where an employer might look at you and say, well, you know, we can switch you from W-2 to 1099 if you would like. So of course, there's some tax savings there for the employer, because the employer no longer has to pay for your benefits. They don't have to pay for half of your Social Security. They don't have to worry about paying for your E&O insurance. But here it is, you go to 1099. Well, you know, is that the type of benefits that you like? And I've had people make decisions based on W-2 versus 1099, simply based on what the cost of benefits might be. So different things there, especially as you're transitioning through. And always comes down to which is better. Well, what's the tax situation for that state, for that county? Do you have a better net income afterwards? Do you want to set up your own retirement accounts? Always thinking about that. I've had people do a fellowship. Their fellowship was funded by NIH. And that fellowship, that money that was sent to the institution to fund that fellowship was then a 1099 instead of an employee. So very interesting how these things get set up even within academia. And having a conversation with that individual, they decided to turn down that fellowship because it was going to mean 2 years away from public service loan forgiveness, which to them was not worth the fellowship salary they were offering. So of course, tax filing. Taxes owed, taxes withheld, do you owe a refund? We brushed on this a little bit earlier, and I apologize for not updating this right here to July. But exactly the same. Did I pay or withhold too much, or did I withhold too little? And going back to the idea of deductions and credits. So a deduction will reduce your taxable income, your AGI. And I focus a lot on AGI because a lot of what I deal with for many professionals is, of course, loan repayments, and loan repayment being based off of your adjusted gross income. It's not your taxable income, it's your adjusted gross income. Now, reductions to your adjusted gross income will, of course, affect your taxable income, but they don't, they don't reduce your taxes due. So a credit, we have say, okay, I got a credit. Your child tax credit, your savers credits, the various credits that are available out there, earned income credit, I should say, savers credit, earned income credit. That actually reduces your taxes to be paid. So if you have, let's say you owe taxes of $1,000, but yeah, you have $1,000 credit, well, that credit offsets what you owe. Now, there's two types of credits. There are refundable credits and non-refundable credits. So let's say that you have a refundable credit. So let's go back to the example used previously. You owe $1,000. You have a refundable credit of $2,000. That $2,000 pays off your taxes owed and then refunds you the remaining $1,000. So that refundable credit creates a refund, as it says in its name, to you. Non-refundable credits, well, you owed $1,000 in taxes, you have a $2,000 credit, and you just don't owe any taxes. Nothing comes back to you. Of course, refundable credits are much better than non-refundable credits, but the idea is that's what the credit does. It negates taxes owed. So a slide on various credits. Again, going here to deductions. A deduction that comes up a lot, of course, is student loan interest deduction. You will lose that once, I believe, your income surpasses $160,000 for a couple, $80,000 for an individual. So typically after your first year as an attending, you will not see a student loan interest deduction. But it is applicable during residency years. Credits really comes down to, of course, are you, you're no longer in school, you're not seeing those. So a lot of the credits don't apply so much unless you have children during residency or even during attending, because credits can actually, you can phase out of credits and deductions based on income. So always looking at those sliding scales as well. You have 529 plans. So here we have, you can use a state funded 529 plan or state sponsored 529 plan to reduce your state income tax in that state. Same as you can use a retirement account to reduce your income, to reduce your taxable income for your federal and state taxes. So you have your credits, your deductions, and also using retirement plans. So just kind of a general sense. So when I would do planning for individuals as a master, as they're moving on to their next phase, you're always looking at, okay, so I got an offer here for this versus I have an offer here for that. How should, what are the financial ramifications if I match here versus if I match there, or if I take a job here versus I take a job there? Always looking at, okay, what is the financial reality? And you're always looking at what is the tax structure of that state? What is this tax structure that you're going into? They'll say places like New York and California have very high tax structures. There's a lot of tax that is paid. You have a lot of people who will say, hey, I want to go to Texas, or they'll go to Washington because they want to remove state income tax. I have clients that will live in Oregon, but commute across the bridge to Washington. It's a few-minute commute, 5 miles. Yet, because they are domiciled in Oregon, they'll pay Oregon income tax, which is close to 10%, versus not having an income tax, and if they had moved to Washington. So you look at, okay, where is it that you live? Where is it that you're domiciled? You can, I live in Washington, but for a long time I would commute into Oregon to work at OHSU, and I would have to pay non-resident state income tax because I earned my income in the state of Oregon. You'll sometimes get people they try and get creative and say, well, Justin, my license says this. I don't really live there. So how does that affect my taxes? Where do you earn your money is who you pay your taxes to. And as you're looking at, as you look at, okay, compensation levels, going back to, okay, can I take a reduced income to work less hours, yet net a closer income to what I'm netting now? I mean, you can do that by, okay, if I live in Oregon, but I work in Washington, I want to work fewer hours. Okay, well, if it's within your lifestyle, you can move to Washington, depending on the factors at play, reduce your tax bracket, reduce your taxation by 10% almost. Simple math of if you earn $20,000, $200,000, that can save you close to $20,000 by making that move. So always looking at those factors as well. Then, of course, in Washington, where I live, we don't have an income tax, we have a sales tax. So every item that we purchase, with few exceptions, clothing, groceries, etc., we pay an income tax on. It really hurts when you buy a car because that car has a sales tax attached to it. One thing to keep in mind, speaking of sales tax, is when you purchase a vehicle or other big ticket item in a state that doesn't have a sales tax, this is especially with cars, and then you move to a state that does have a sales tax. So if we lived in Oregon, purchased a car in Oregon, then in, let's say, the next month we move to Washington to register our car, we will pay sales tax on that car purchase in the state of Washington because we bought that car within a month of moving. Actually, in the state of Washington, I believe it's 6 months. So you'd have to actually own that car for over 6 months, then move, and then you wouldn't pay sales tax. This is something that happens, of course, as people transition between different states as you're moving around during your careers or during training. After training, is you might make a big ticket purchase in one state, not realizing that when you go to register that, let's say, most likely the vehicle in the next state, you have to pay taxes over there. So always looking at, okay, how are these transitions? How does taxation affect those various transitions? So you can go, of course, look at state income tax and what they have for their different tax rates, what are the different, what do they consider taxable income, how do they treat different types of income. So as you transition to, of course, tax planning for retirement, going back to everything else, we've been talking about earned income, W-4, 1099, etc. And then you get to what, when people say, when I go to retirement. And back in the late 90s, early 2000s, they were talking about the retirement time bomb. And what they meant by that was that up until the late 90s, there were no after tax, there were no Roth IRA accounts. So every dollar a person had been saving for retirement was tax deferred until they took it out in retirement. And when I first entered into finance and I started sitting in on client meetings, you'd hear clients ask, why is it that their tax rates didn't go down in retirement? It was very simple. Because in retirement, you don't have any more deductions. You're not adding to your retirement anymore. You're not adding to your 401k. Yet every dollar you saved pre-tax, you're now pulling out at your full income tax rate in retirement. So if it costs you $100,000 a year to live, just as an example, in retirement, and the only thing you have is pre-tax accounts, you would have to pull out or distribute from your retirement account enough income to net $100,000 after tax. So you have these people who are in the 25% tax bracket while they're working, and they transition back into the 25% tax bracket in retirement because they got rid of all their deductions and every dollar they have is taxable income. So that led to a lot of planners going back to the spigots that we used in that last presentation that we gave last week, is diversification, saying, okay, well, people talk about how can I reduce my taxes now? Well, yeah, that's now. We can talk about now because that's what you feel right now. That's every day you feel what your taxation is today. You're not thinking about taxation in the future for retirement. But when you get there, you're going to say, okay, well, if I only put money in pre-tax for the last 20, 30 years, that means I'm going to be pulling out nothing but fully taxable income all through the rest of my retirement. So when I talk to people, or when you get in these conversations about, okay, how should I save? How should I invest? How should I, diversify my income? Always look at, okay, well, you have your diversification for your investments. You have your diversification for current and future taxation as well. And it's always important to keep in mind. So if you are, during residency, I'll tell people to add to your Roth IRAs while your income is down and your tax brackets aren't higher. As you transition to attending and income starts increasing, you start looking at, okay, how many different retirement accounts do you have available to you? If the only thing you have is a 401k, okay, then what else can you use your money? What else can you invest your money in that can create a future cash stream in retirement? Because I want to make sure that when you retire, not every dollar that you have is being taxed. And that's something that, again, people don't think about long term. So now you're talking about, okay, well, if I have my Roth account, I don't have to pull, if my income is $100,000 a year, if that's my need is $100,000 a year, and every dollar coming out of a Roth account is tax free, I only have to pull out $100,000 a year. It's dollar for dollar. It's tax free. And so always thinking about that. Or you would have clients that would pull, let's say they had a combination of pre-tax savings accounts and after-tax savings accounts. Okay, they would pull $100,000 out of one account and out of their taxable account, and they'll pay the taxes on that. They'll pull the taxes due out of a after-tax account. So always thinking again about future taxation. So tracking, and we're getting to the end here, and we'll have questions. Tracking is essential. My wife's a CPA, and she used to work in individual tax for PricewaterhouseCoopers, and now she does corporate tax. And she would say that it's hard to come up with a tax plan when a client never had a system in place. Like literally just receipts and things shoved in an envelope, and it just says tax, and that's it. They never took the time to say, okay, what do we have going on in our situation that we need to track to make sure that we are setting ourselves up, of course, in terms of taxation going forward. And I always tell people, as you're transitioning, if you're starting your own business, if you're going to be an independent contractor, what are your business expenses? Itemize them, track everything. What are your future deductions? Track everything. What is it that you are trying to accomplish tax-wise? What is your tax plan for that year? And I'll tell people, it makes sense to hire a CPA or what is known as an EA, an enrolled agent. Your tax situation might start simple. I mean, at the start of almost every career, your tax situation is simple. But complexities start adding. Family, homes, rental homes, you inherit money, you start selling assets, you have non-liquid securities you invest in. I mean, it's interesting for me to watch an individual's situation go from something that seems so simple to something that's incredibly complex over time, to where I've had people come to me during their fourth year of medical school and say, yeah, well, I just inherited the family farm. Now what? Okay, well, now we have to do these other situations. It's never fun to think about, okay, what is inheritance? How that change if somebody else passed away? But literally looking down the line saying, oh man, well, my tax situation is really simple right now, but I'm supposed to take over this business, or I'm going to sell that then, or I have something that's due to me in 4 years. It's always, again, planning for that next transition and looking down the line or looking down the road and saying, okay, what might happen next that will affect what I have going on right now that might shake things up, and how do I prepare for that? So again, always analyzing, always reviewing. If you're sitting down with a tax professional, it should always be, okay, what do I have going on? What should we be looking for? What is our future tax? If you're looking at loan repayment and taxes, how does it affect you to do married filing separately versus married filing jointly? Are there tax savings involved there? And does it make sense to do that to save on payment as well? So, what parts of your life are going on that are directly affected by tax? And always making that plan, looking at it, adjusting, and going forward. I know it's very simple to think about, but again, as you get busier as professionals, it's sometimes hard to start planning. I mean, I'm sure some of you might be thinking, okay, well, I'll get to notes later. I'll type my notes later. I'll type my notes later. Then all of a sudden you're like, oh my gosh, I have to do like a week of notes in one night. And I just got off the graveyard. It just, life catches up. So again, look forward, plan, adjust, change, and always look at taxes as a living thing. They're never static. The choices that you make will affect you later down the line. And as you're looking at tax, don't look at it just for the year that you're in now. Look at it for later years as well. So we've actually finished right at an hour. Any questions at all? I'm going to have my question bar over here, so I'll bring it down this way. Okay, I have a few here. Wow, quite a few here. So we had one actually earlier. I apologize I didn't get to it. So yes, the lectures are going to be recorded. And it looks like no other questions right now. So, thank you so much for spending your evening tonight with us, and look forward to seeing you at future talks, and appreciate any and all feedback, and take care, stay healthy, be well.